Hello, and welcome to the June 2023 Economic and Market Update presented by Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. After a mixed April, financial markets generally pulled back last month, with the notable exception of the Nasdaq index. The Nasdaq, which is largely technology companies, gained on positive earnings surprises and general enthusiasm for artificial intelligence, while other markets were pulled down by concerns over the debt ceiling fight in Washington. The Nasdaq was up by just under 6%, while other U.S. markets were flat or down slightly. International markets, both developed and emerging, also pulled back a bit, as did fixed income on higher rates. After a strong start to the year, markets were due for a quieter stretch, which also makes sense given that the summer season is typically quieter. Although May was a quiet month, the good news is that the primary headwind, the debt ceiling, may be on the verge of being solved. A bill to raise it has passed in the House and is now awaiting Senate action. If passed, this will take the debt ceiling off the plate for this year and next, removing the major political worry in the markets. That would be good news, and it's expected shortly. But while the political news is getting better, though, the major economic worry, inflation, showed signs of getting worse. While inflation is down significantly this year, the May data showed signs that it may be picking up again. With that news, markets reversed the prior assumption that the Federal Reserve would pause rate hikes and drove rates back up. That was another headwind this month, and one that needs to be watched going forward. But while inflation may be picking up again, though, it is for a good reason: the continuing strength of the economy. Last month saw job growth beat expectations, coming in very strong, even as consumer and business confidence ticked up and spending increased strongly. While a recession remains possible, the data suggests it's still some ways away. Corporate earnings also showed surprising strength, suggesting that companies continue to operate successfully. In short, the data so far continues to be better than the headlines. And even though the economy may be slowing, it is still growing. But while the outlook remains positive, there are, of course, still risks. The biggest is the debt ceiling confrontation, while almost solved, isn't there yet. The second is that the Federal Reserve will decide to raise rates at the next meeting after all, which would be a surprise and could rattle markets. Beyond the U.S., of course, we still have a war in Europe, as well as the China wildcard. And that's not even considering the risks we don't see yet. Nothing is guaranteed. But despite those risks, as we look ahead, the fundamentals are still healthy. The economy is slowing, but it's still growing. We appear to have avoided a political disruption, which is a big positive. And while there are still real concerns around inflation, the likelihood is that we'll keep making progress. Last month's news was mixed and dominated by political worries, but overall, there was more good than bad. And that improvement looks likely to continue. Over the next several months, for example, we'll know where we are with the recession, and inflation and rates should keep getting better. In other words, we do face real risks, but we'll keep moving past them. We're certainly not done with turbulence, but despite the headlines, we are in a pretty good place. That's it for this update. Thanks for watching. Join me in July for the next one, but until then, be sure to check my blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. We are getting through this together.